All right, let's get right into it. Hello, everybody, and welcome to this Masterclass Explainer. I'm Ibrahim, and alongside my co-host, we are absolutely thrilled to guide you through Phase 2 of our journey. Today, we're setting aside all the noise, we are stepping away from the chaotic amateur retail crowd, and bringing you a truly elite, quantitative deep dive into the ultimate playbook of the corporate world.
Exactly, Ibrahim. The energy today is absolutely high level. It's all about strategic capital allocation. We're looking at the hard math, the strategy, and the literal mechanisms that the most successful financial architects use to build absolute fortresses of wealth. Let's just dive straight in.
Welcome back to the Neuro Finance Masterclass. Today, on day 116, we uncover the silent wealth catalyst of the corporate elite. Now, remember yesterday on day 115, we diagnosed that frantic retail mania using network gas fees. It was a wild, incredibly noisy environment. But today, we are completely transitioning away from that noise. We are stepping straight into the corporate boardroom to master the highest form of capital allocation. We are talking about businesses that are absolute fortresses, generating just massive amounts of free cash flow.
Yeah, it's a total paradigm shift from yesterday. We're moving from the chaotic speculation of the crowd to the highly calculated, silent, and massive moves of top-tier executives.
So, think of this as your exclusive corporate playbook. We'll kick things off with the silent wealth catalyst, then dive right into the mathematics of scarcity.
From there, we'll compare buybacks to traditional dividends, warn you about the toxic debt trap, and finally, perform a hands-on buyback audit. Let's get to it.
All right, Section 1, the silent wealth catalyst, entering the corporate boardroom.
I want you to imagine entering the corporate boardroom of a true fortress business. This company is a machine, right? Just generating massive free cash flow. The CEO is sitting there at the head of the table, facing one defining choice. What exactly do we do with all this surplus cash?
And honestly, they really only have three viable options. They can reinvest it back into the business to chase growth, they can pay it out directly to shareholders as a cash dividend, or they can execute a share buyback. So what is a share buyback? Well, it occurs when a corporation uses its surplus cash to purchase its own shares straight from the open market and then effectively cancels them. And listen, how a CEO makes this specific allocation pivot completely determines the long-term wealth of their investors.
You know, amateurs just obsess endlessly over dividends. They desperately want that immediate cash in hand. But the true architect, the elite capital allocator, they know that a well-executed buyback program is the ultimate silent catalyst for multi-generational wealth expansion. It just operates quietly in the background, continuously making your slice of the pie bigger and bigger without you having to lift a single finger.
Moving on to Section 2, the mathematics of scarcity, specifically engineering EPS optimization. All right, this is where we shift away from philosophy and get into hard, undeniable mathematics. When a company buys and cancels its own shares, it is fundamentally shrinking the company's total floating supply. There are simply fewer shares available out there in the open market. We are quite literally watching a company engineer scarcity in real time.
To really grasp this, we have to look at earnings per share, or EPS. The formula is simple: net income divided by total shares outstanding. Now, I want you to mentally zoom in on the denominator of this fraction.
Yes, because that is the mathematical trick. That's the secret weapon of the boardroom right there. You don't necessarily need the top number, the net income, to go up to create immense value. By utilizing a share buyback, the company directly attacks that denominator, forcefully shrinking the total shares outstanding.
And this table brilliantly illustrates the raw power of that shrinking denominator. Just look at this before and after scenario. In our baseline on the top row, the net income is flat, the total shares are at 100%, so the EPS is standard.
Right, but look closely at the second row. The company executes a 10% buyback. Notice that the net income stays completely flat, meaning the business hasn't made a single extra dollar in actual profit. Yet because the total shares drop to 90%, the EPS mathematically skyrockets. It's an automatic structural optimization.
So, the absolutely crucial point here is how the market reacts to this math. The stock market prices equities as a multiple of their earnings, what we all know as the PE ratio.
Exactly. When you have this structural increase in EPS, it automatically forces the individual share price upward just to maintain that baseline multiple. The company hasn't necessarily launched a revolutionary new product or conquered some new market. They have simply manufactured scarcity in plain sight. They engineered a dynamic where the exact same earnings are split among fewer shares, driving the value of every single remaining share significantly higher.
All right, let's head into Section 3, Buybacks versus traditional dividends. We like to call this the sovereign shield. Now, you might remember our deep dive into dividends back on day 111. But a really great question to ask yourself right now is, why do premium corporate monopolies, think of absolute giants like Apple or Berkshire Hathaway, why do they prefer buybacks over those traditional dividends? It all comes down to a stark contrast in wealth preservation, specifically capital efficiency and the brutal, unavoidable reality of taxes. See, when a company pays you a dividend, it triggers an immediate taxable event in most jurisdictions. You are literally forced to pay income tax on that cash on day one. It's a massive tax strain. But buybacks? There is absolutely no immediate tax triggered. The company takes that cash and reinvests it directly into your ownership block by destroying the competing shares. Your fractional ownership of the overall corporate machine expands seamlessly. You only pay capital gains tax years down the line when and if you actually choose to sell. It acts as a sovereign shield, essentially functioning as a compounding compound machine.
Which brings us to Section 4, the toxic debt trap. This is the leverage red flag you need to watch out for.
Because listen, it is not always a perfect wealth machine. As a financial architect, you must apply a strict analytical filter here. We have to clearly distinguish between organic wealth creation and highly dangerous corporate engineering.
Right. If a buyback is funded by genuine surplus free cash flow while the stock is actually undervalued, it is exceptionally bullish. But if a company has weak underlying fundamentals and a bloated debt-to-equity ratio, that is a massive leverage red flag.
Absolutely. If a company is out there borrowing expensive institutional debt just to buy back its stock and artificially pump its EPS, you need to run away, fast. They are literally burning their own financial skeleton simply to inflate short-term executive bonuses. This isn't wealth creation at all. It's financial sabotage masking as a buyback. You absolutely must verify the source of the capital.
And that leads us to Section 5, performing a buyback audit. This is your cognitive task for today.
This is where we turn all this elite theory into immediate, tangible action. We don't just want you to nod along and understand the math. We want you to apply this masterclass directly to your own portfolio watch list right now. It is time to put your holdings to the test. So here is the exact audit process, step by step. Step 1. Pick a primary stock from your portfolio watch list and open its financial statement metrics. Step 2. Find the shares outstanding, or Sermaye by Hisse Adadi, trend over the last 5 years. Is that share count shrinking consistently? Is it just staying flat, or is it actually expanding?
And step 3, cross-reference that trend with their free cash flow profile. If the share count is expanding, you are actively suffering from continuous dilution. You need to know for sure if the company's funding any buybacks with real cash flow, or if they're falling into that toxic debt trap we just talked about.
So, the crucial point here is this hard-hitting takeaway. Stop trading diluters. Just stop. Stop holding companies that constantly print new shares and actively shrink your slice of the pie.
Instead, you need to align yourself exclusively with scarcity. Invest in corporate machines that aggressively buy back their own history, completely control their supply structure, and ultimately rule the economic cycle. You want to own the compounding compound machines for sure.
So, we'll leave you with this final provocative thought for day 116. Really look at this question and ask yourself, are your portfolio companies actually building generational wealth by shrinking supply, or are they just constantly diluting you? Take a really hard look at your watch list today, guys. Run the audit, find those silent wealth catalysts. Thank you so much for joining us for this explainer, and we will see you in the next masterclass session.